Hello there. I will say, I just kind of own the fact that I think this is the most punctual capital access convening we've ever had. Normally, this is the part where we're rounding people up who are having side conversations and trying to do some of that. So it's kind of funny, goodness gracious, I don't think we've ever run on time. And I will look forward to not running on time next year with you all. But in the meantime, we will celebrate by starting on time, coming back from our intermission. For those of you who might be newly joining us, I'm Crystal Langholtz. I'm Chief Operating Officer for First Nations and WISTA. And we have a really exciting next session with you all. We are going to be talking about rebuilding our economies post-COVID-19, focusing on the use of guarantees. Guarantees, of course, are a wonderful option for risk mitigation for our native CDFIs, and something that I think we all could stand and learn more about. And we have a really exciting panel to walk us through that. And Terry Lovelace is going to be our facilitator for this session, and she is the president of Locust Capital. And Locust is a 4-year-old national social enterprise launched by Virginia Community Capital. And she serves as the executive of the Community Investment Guarantee Pool, which is a guarantee pool that's focused and built funded by philanthropy. So we're going to get to look at guarantee from a variety of different places, and we could have no better navigator on that journey than Terry. So with that, I'm going to let Terry kind of take us away, and I'm so looking forward to learning more.
Great, thank you so much, Crystal. And everyone, welcome to our session discussing guarantees and their use in rebuilding our economy. Thanks to Crystal, Brian, and the others at OWISTA for including this important topic on the conference agenda. And thank you to the esteemed panelists for sharing their knowledge and expertise with us today. Now more than ever, credit enhancements like guarantees can help CDFIs and other community lenders get capital flowing to those populations that have been hardest hit with the pandemic, and to those historically disenfranchised communities that have been systematically excluded from equitable access to capital. As Crystal stated, my name is Terry Lovelace, and I'm founder of Locust Impact Investing, which is a national consulting firm and asset servicer helping foundations use more of their assets for local impact investing. My parent company is a CDFI loan fund and CDFI bank with 550 million assets under management. And I am the executive director of the Guarantee Pool, which you'll hear more about later in the presentation. I would like now to ask Joel and then Christine to introduce themselves. Joel?
Great, thank you. Good afternoon, everybody. I'm glad to be here. My name is Joel Smith. I'm a member of the Caddo Nation of Oklahoma, and I am the Senior Vice President and Chief Credit Officer at Native American Bank. For those that are not yet familiar with Native American Bank, we were formed in 2001 by a group of founding tribes led by Eloise Cobell that had a mission to build a bank owned by natives that would specialize in providing banking services to Indian country, recognizing the severe lack of access to banking services historically. We've grown a lot since back then, almost 20 years now, and we now have a ownership base comprised of 31 different tribes, tribal corporations, Alaska Native corporations, in addition to 4 foundations or social investors that make up our bank. We spend almost all of our time focusing on providing banking to Indian country. So we are we serve markets across the United States. We're in 21 states currently, but functionally, we're specialists in providing capital on reservations. That's, the expertise that we saw lacking, and that's our pride in how we are available to tackle those projects specifically, and that's lending to tribes themselves, to their economic development corporations, housing authorities, in addition to Native entrepreneurs and small businesses. We are headquartered in Denver, Colorado, but functionally end up doing little business in Colorado as we're sort of following the map of reservations. We do commonly utilize guarantee programs in our lending at the bank. We use those to enhance our lending activity, and I will be sharing some of those insights with you later here in the presentation. So thanks very much, and I'm glad to be here, or virtually.
Thank you, Joel. Christine.
Thanks, Joel. Thanks, Terry. Good afternoon, all. My name is Christine Ryan. I'm the manager for program-related investments and a member of the impact investing team at the California Endowment. TCE is the largest private foundation in the state of California. We are focused on health equity and based in Los Angeles. We take a community and not a population lens approach to our mission of health equity and define health very broadly to mean the social determinants of health and therefore financial wellness. We are a younger foundation compared to our national peers. We are 25 years old and have been doing impact investing since 2011, so for the past 9 years. In terms of philanthropic guarantees and an impact investing lens to that, we view guarantees as either a standalone or a complementary product to our impact investing portfolio of mission-related investments, program-related investments, and strategic grant capital, all which serve to further our programmatic objectives. And guarantees are unique in that they allow TCE as well as other foundations to leverage the strength of our balance sheet. TCE has $3.6 billion in assets to further mission without having to front the dollars that grants and loans require. Our approach to using guarantees is via partnerships and intermediaries, which I'll discuss more of when we discuss in depth around the philanthropic guarantees. But lastly, just want to offer that even though we've been doing impact investing for 9 years, we still very much consider ourselves on a learning journey, and that we are exploring guarantee use cases and how we can be a philanthropic guarantee lender. And so happy to share with you today our thoughts on our journey, and also to discuss the topic with you and continue our learning process. And with that, I'll turn it back over to Terry.
Great, thank you, Christine. If you turn to the next slide, we wanted to get a feel for the audience today, and we have 3 quick polling questions that I'm going to turn it over to the technical folks to help us do the polling. So you should see questions. If you can take a few moments and just answer these 3 questions and submit.
We'll just allow about 15 more seconds. We have 60% of the participants voted, so just cast your votes now. We'll close in 3, 2, 1.
So it looks like out of the participants, about 27% of the audience have already used a guarantee in their lending program. And most of those participants on the conference who have used a guarantee, it's been a government guarantee versus a philanthropic guarantee. And it's about evenly split about what people want to learn today on how to access guarantees and when to use guarantees. So thank you very much for answering those questions so we can get a better feel for the audience. What I would like to do now is to just give a short primer about guarantees. Crystal mentioned earlier that they are one of the best credit enhancements that can be used. And it's a credit enhancement where one party legally promises to cover all or some of the obligation of another. So think about a parent who co-signs or guarantees a car loan for their adult child. That parent is allowing capital to flow to their adult child to purchase that car. Guarantees can be both funded as well as unfunded. And you will hear later there can be both government guarantees as well as philanthropic guarantees. One of the best power of guarantee is it helps capital flow where market forces may have limited the flow of capital. So think about real estate transactions in more underserved communities where property values may not appraise to the level necessary to meet certain loan to value criteria. A guarantee can still help that capital to flow. A guarantee may also help reduce risk of perceived risk of default or loss on a lending product. Think about lending to entrepreneurs, female entrepreneurs. There may be a perceived risk that this type of lending is higher, where in fact it isn't, but a guarantee can help eliminate that perceived risk. There's also the benefit that guarantees can help crowd in more traditional or more risk-averse capital and have a exponentially larger impact through a guarantee than could be done through other means. So when you use a guarantee, think about transactions that can be de-risked so that other capital can flow into that lending arena. Think about using guarantees when you want to de-risk for greater, deeper community impact. Guarantees can be used when there's new products or programs being tested in the market for the first time and that the risk isn't well known yet. So those are some of the larger themes of when a guarantee can be used. Think about de-risking a transaction to allow your capital to flow or to allow someone else's capital to flow, particularly to make deeper community impact. So now I'd like to turn it over to Joel to gain some insights on guarantees from a financial institution. Joel?
Thanks so much. So I will start by prefacing that the type of guarantees that we utilize and that I can speak to are more on the commercial side. Of course, there may be other avenues out there for consumer credit or mortgage, individual mortgages, and that's not something we have dealt in greatly at NAB as much as we have the different vehicles to provide commercial guarantees. And so that's going to be a lot of the context in which I'm talking through this. So to start, I wanted to share some of the high-level considerations that we look at when we're deciding to utilize a guarantee. across guarantee programs, the first and foremost reason that you'd want to utilize a guarantee is to act as a backup plan, secondary or tertiary source of repayment to offset the amount of a loss if your primary source falls through, right? If the business goes under or is not able to perform to its expectations, and you have a default, it helps you in that instance. So there, you don't, related to the collateral, there's a lot of loans that get turned down because they don't have sufficient amounts of collateral, right? There's banks and enterprises that say, I really need that hard real estate, I really need some equipment. And there's a lot of small businesses out there that's the one thing that's lacking, right? They're a deserving business that needs a helping hand to open up. And these are principally when guarantees are used to support a lack of collateral, or instances maybe where the collateral might be harder to liquidate, maybe in a tribal jurisdiction or a leasehold interest, on a reservation, where you can enhance that risk with a guarantee. So principally, that is the one thing it's used for most. I will say some of the other benefits of using guarantees is you have a lower loss exposure. So that can go a long way to stretching your allowance for losses, right? So if you have calculated loss amounts and you have to stay within that, you can go a lot further if you can stack guarantees in that portfolio. And if you have a certain appetite for loss for a given loan, that will allow you to provide a much larger loan than you would have been able to otherwise with the same loss exposure. So obviously providing bigger loans to deserving businesses is one of the biggest ways that we look to utilize this, especially as a bank where we have a legal lending limit prescribed by our regulator, and can go beyond that to be able to provide projects financing. Projects that don't project to be able to cash flow won't generally be helped by a guarantee. So just so we know what we're talking about here, the business has to be able to repay the loan from its sources. It can't really reduce the risk that a default happens. It can reduce the loss if a default does happen. So overall, you can build a business model that takes more risk, or is okay with going to a little bit more of a speculative business model because the eventual loss exposure is lower, as long as you recognize your probability of default might still be higher on those credits. So it's a balance, and it lets you potentially be more aggressive, but it doesn't generally help the primary source of repayment. I say generally because there's a few programs out there, most notably the BIA loan guarantee that has interest subsidy. That is a mechanism that can add to the cash flow and then help giving the primary source a helping hand, but those are few and far between. I'll mention a big way people utilize guarantee programs is to access the secondary market. So a lot of loans that carry, for instance, SBA or USDA guarantees, you can take the guaranteed portion and offload it to some investor. And there's these organized markets that will pay you a premium and enhance the profitability of your lending operations, and let you recycle your balance sheet. So you don't have to hold that entire loan on your balance sheet. You can do a lot more loans at the same time while being able to access that. So it's a great way, especially if you have limited liquidity in your loan portfolio, to be able to do more volume. Have to, of course, mention compliance risk as a major consideration. Guarantee programs come with a lot of with requirements that you have to be on top of. That means writing policies, that means knowing what you're doing and remembering. And some of the challenges that face small lenders is it might be a 1 or 2 person office, and someone that originates an SBA loan or an FSA loan knows all the hoops to jump through. But if they win the lottery and move, and someone else comes in, you have to be able to stand behind that, because there's a risk on you as a guaranteed lender to service the guarantee, or else you can jeopardize whether the government largely will be there when it's time to pay on a loss claim. As I mentioned, there's a number of different guarantee programs out there. SBA, USDA, I'll mention some on the next slide. And there's very specific instances when they're available. So it's going to be dependent on geography, who your borrower is. Like if they're enrolled native, they are eligible for more programs than otherwise that we have to account for. So with that, I will go into a little bit on some of the primary commercial guarantees that we see out there. I list them here, and I also go over a matching challenge that we see just to show you the balance you have to have between these considerations. The SBA program, which a lot of people are familiar with, is very involved. It's probably the biggest one that we see, with the risk that if you don't cross every T and dot every I, you might have a problem once you claim on the guarantee. Just to highlight that, it's a great tool, has a great secondary market, but I call it high compliance risk. The SBA has another program called their 504 that provides you basically an enhanced loan to value as they take some of the loan onto themselves. So it's not actually a guarantee, but an enhancement that has a lot of fees and means you have to have a pretty high project size to be able to make it worthwhile. The USDA, we see commonly work well in rural environments, especially reservations, but they're a lot less flexible on collateral than the BIA and SBA, for instance. And so they work great if you have collateral, but it's harder to get it to be a collateral enhancement on that program. You can see some of these other ones. The FSA is particular to ag lending. And as we all know, ag lending can be very hands-on and detailed, and you might have a lot longer list of things that you have to chase down per their requirements than you might be inclined to otherwise. So in a lot of these cases, it's more work, more time investment from the lender perspective. The Office of Indian Energy and Economic Development, or OIEED, we commonly refer to as the BIA Loan Guarantee Program, is a great program in many respects. They have a very high 90% guarantee that can really enhance a lot of projects, but they have challenges being adequately staffed. Just the budget from the government has been hard on them being able to have a big enough personnel as a small program to be very timely. So if something has to be done and done tomorrow, that can be hard on the processing times that we see for approvals coming from there. And very notably, that program doesn't have a very deep secondary market. So all those benefits of, hey, you can easily offload a guarantee certificate from an SBA loan, for instance, are not really in play. If you have a BI loan guarantee, you're probably going to have to keep that on your portfolio in most cases. They do have a subset of a program they call their loan insurance for loans of $250,000 and below. That's great because it's a streamlined program where they say, if you follow the rules, we'll let you insure the loan and tell us about it later and not wait for our approval. And it's great, especially they can use it for ag, you can use it for any number of industries that work well if you have the loan sizes that it fits. Problem is, they say the loan guarantee is up to 90%. So the drawback is they limit it to the size of your portfolio. You can only have a claim equal to 15% of the entire portfolio at one time. So the guarantee percentage is kind of a moving target depending on how big you can build that up to. If you have one loan, it might be a 15% guarantee. You have to really commit to doing several of these and building a portfolio to make it worthwhile. I put in the HUD Title VI, which is an Indian Housing Authority specific program. It's one of the best guarantee programs out there. It's actually 95% guarantee. And its problem is it is such a small niche program. There's not a lot of funding to go around in the country. And so that program and sometimes others can get stuck with, it's June and the fiscal year ran out of money. You might have to wait and cool your heels until the next fiscal year. So it's just something you have to be up to speed on to not get caught by surprise. So with the last slide here next, I wanted to highlight a few loans that we've closed and been able to utilize various guarantee programs just as a example of how these can be utilized. We were approached by a native business owner in Portland that wanted to acquire the rest of the stock of a data center company that they owned. Not much hard collateral to speak of. We needed a guarantee enhancement. However, the BIA guarantee doesn't work in urban areas. It's really related to reservation communities. And so we utilized an SBA guarantee in that case for a $3 million loan that we were able to provide to the individual native business owner. We had a tribe come to us to build a new water treatment facility. And it was way bigger than we could handle ourselves with our legal lending limit. So we stacked a 90% BIA guarantee to be able to provide a much larger credit than we would have to otherwise. Again, one that would be really tough to liquidate as well. That helped us mitigate the trust land situation, as well as being able to how do you liquidate a water treatment plant to a different operator. Mentioned the BIA insurance program, and I put an example in here. We had a trucking company operator down in Navajo that came to us for $200,000 to acquire some piece of equipment. And we thought that was a great fit for that to start building our insured portfolio. And notably in that program, you do have to liquidate yourself. One consideration I didn't quite get into is generally, if you have collateral, the guarantee programs will expect you to still liquidate, and then you can claim on the deficiency or what's left. The BIA insurance actually gives you the flexibility to just take your 90% and assign them the loan and not have to deal with liquidation, which is a great benefit, but the insurance, you still have to. Last quick highlight I wanted to put in there was something that we profiled at previous convenings, was a loan to tribal grocery store in Minnesota. We utilized the USDA guarantee because that guarantee program worked the best alongside New Market Tax Credits program, which is very specialized and very hard to fit together with all of its requirements. The USDA spent some time making sure that they work together. We were able to stack that into the project to make it come to fruition, which was a lot of work, but something that the guarantee made happen. So that brings me to the end of my presentation as far as this quick highlight into some guarantee considerations and examples. So I'll be available for questions, and thanks very much.
Thank you, Joel. For all the attendees, the PowerPoint will be shared with you all, and there are links at the back of the PowerPoint that are resources for a lot of the programs that Joel mentioned in his talk. So now I'd like to turn it over to Christine Ryan to talk more about the philanthropic guarantees.
Great, thanks Terry, thanks Joel. So switching lenses a little bit and moving into the philanthropic orientation about how we think of guarantees. It is different than some of the federal and state credit guarantee programs that Joel was discussing. I will just add as a total aside, guarantee with a Y and guarantee with 2 E's are completely and totally interchangeable, and both are correct and okay. So if I know if you have a high attention to detail, it might bother you as we're going back and forth between the slides, but they're both completely and totally acceptable. As a foundation, our orientation is really that guarantees are a tool or a product for mission. And so, as I mentioned in the introductory remarks, we take a community health lens approach to our health equity mission. And we think about how we can use guarantees to support healthy community capital development ecosystems. And what that means is, how does capital flow in a responsible and meaningful way to housing or small food, and food access, small food entrepreneurs and food access, or to small businesses. And the orientation is really to use a guarantee to decrease either real or, as Terry mentioned, perceived risk, so that capital flows to projects with our approach via intermediaries, so that we're achieving positive health outcomes in communities that we care about. And the objectives around that, the project level is obviously very important, but we engage with intermediaries because we want to support CDFIs, credit unions, the community investment guarantee pool that Terry is going to discuss in their capacity and their muscle to use guarantees and to be a values and mission aligned community capital actor. And so I share this orientation because it is different than how federal credit programs think about the use of guarantees. And the federal credit programs have their predefined box, as Joel was explaining, and it's pretty constrictive. I say this having come from an international federal credit program. I did work in DC for 8 years, and so I have experience being within the federal government on a guarantee program. And in addition to the predefined box, there's strings, as Joel was saying. There are strings attached. And so when we think about use cases for philanthropy, there are both benefits and challenges to how we think about philanthropic use cases. One, we can be much more creative and we can co-create what the use case is. We're not going to pre-describe what the small business loan has to be, or predetermine, what the HUD housing loan has to be. There can be a lot of partnership between the financial intermediary, who for us understands at the project level, and the foundation. There can also be lessons learned and kind of an iterative process. As I mentioned at the beginning, even though we've been doing impact investing for almost a decade, we are on a learning journey. And under the direction of the Impact Investing Director, that's a very important part of our journey, is to be iterative and to understand what those lessons learned are. There are challenges around the use cases, I think. However, because we are learning in real time, this is, broadly speaking, a newer product in the national philanthropic space. And so there can be uncertainty when you're testing a new product. There can be a, how do you get the credit enhancement right? Meaning, is it a 10% guarantee? Is it a 20% guarantee? How do we ensure the actual structure of the product is correct? And so there's a need for us, as well as for the partner, for some flexibility and an openness, I think, in philanthropy, which we come to the table with to iterate on the product and understand the product and the product use cases as well. I'm going to incorporate any comments related to racial equity and how guarantees further our commitment to racial equity in my example when I talk about our Fresh programming. But staying kind of on the benefits and challenges of using philanthropic guarantees, I think they are funded or unfunded. Ours are unfunded, meaning that we don't put any money aside up front when we legally and contractually obligate to pay. And so there's no money going out the door, and our grant budget isn't impacted by that, and our PRI loan allocation is not impacted by that. So we see that as just this significant opportunity to leverage a very large balance sheet for greater mission impact. On the bilateral versus the pooled guarantee approach, bilateral meaning TCE as a foundation and an intermediary, CDFI or credit union, there are only two parties at the table when we're talking about use cases. And so the co-creation process can move a little bit more quickly, and we can also iterate as we need to pivot and incorporate those lessons learned a little bit more quickly when it's a bilateral relationship. But bilateral relationships don't build the field the way a pooled guarantee approach does. And so while you may have more funders at the table and you're thinking about a pooled approach, you're increasing your own leverage. So if I'm putting in $5 million, we're getting to a $33 million pool. So you're increasing your leverage, the field building, and there's foundation to foundation capacity building that TCE sees itself as an important partner in, so that we're supporting something that's bigger than just our organization. On the FreshWorks example, this was a very long time coming and somewhat complicated but very impactful transaction. And so TCE has had a commitment to fresh food access for going on 20 years. And so we had iterated on our fresh food programming. And in 2018, we were moving into our third or fourth grant iteration and our second capital PRI iteration with our fresh food access. This was a $5.5 million multi-funder, multi-lender, PRI, strategic grant capital, and guarantee transaction. So there was a lot for the program manager to hold. And it was to target food businesses in low income and off-color communities to have access to capital that are either ignored by the traditional capital system or, quite frankly, market forces move to eliminate them. What we found was that the loan capital with the grant capital was not enough during the previous iteration of this program. And so what we offered directly between us and the program manager, there were other lenders that were providing PRI debt capital, but weren't comfortable providing the guarantee, but TCE so directly engaged in a side agreement with the program manager for a 25% credit enhancement guarantee on loans that were going to designated of color and minority owned small food businesses in California. What this did that was unique is that we have a multi-lender network throughout the state of California that is 7 CDFIs. And so one, we grant funded market making, which meant that we were in the field supporting these small businesses and their access to understanding what capital is and how you get to the point where you're able to apply for credit. Then sent them to one of our network partners, and the network partner has, what we call its credit box, as you're familiar with. And even with all the market making, there were still a lot of businesses that are outside of that credit box. And the lenders could not get comfortable, even as CDFIs, pushing that credit box. So what we said was, okay, TCE and our balance sheet up to 25% will guarantee that you need to go outside of your credit box. And that has supported 2 lenders right now in the network to be able to push food access, push credit to food businesses that they would not have been able to without that. So with that, I'm going to stop and turn it over to Terry to talk about the CIGP.
Great, thanks, Christine. And that was a wonderful example of FreshWorks, how the guarantee allowed the capital to flow, and it wouldn't have if TCE had not made that 25% guarantee. What I would like to talk about briefly is a new community development infrastructure called the Community Investment Guarantee Pool. We call it the pool, or CIGP, and it serves as a centralized source of credit enhancements for intermediaries, like many of you on the call today. The CIGP closed last December, and currently we have $38 million of unfunded guarantee commitments. The pool is attempting to reduce the complexity and build capacity to deploy and manage guarantees by foundations. And it's in serving as a centralized credit facility. It provides intermediaries like CDFIs one place to go to find a guarantee and apply for a guarantee, so that you're not out shopping around with philanthropies in your region seeing if they do guarantees. The pool is also designed to accelerate community investments without requiring current endowment liquidity from the foundations. And that's really important given the current environment we're in. The foundations don't have to fund a guarantee, but instead can leverage their balance sheet. And the pool also allows philanthropy to mitigate losses by sharing the losses pro rata among all of the investors. So we closed last December, and we have 12 investors, and they include the California Endowment, Kresge Foundation, Robert Wood Johnson, the Chan Zuckerberg Initiative, a community foundation in Seattle, as well as some family foundations. And we also have a healthcare system, Common Spirit Health System joined the pool. And the goal of the pool is to get capital flowing to communities and to organizations that traditionally have not had access to the capital. So think of your smaller CDFIs, native CDFIs, community lending partners that may have been not able to access the lending capital that some of the larger intermediaries are able to. It's also a multi-funder collaborative to allow philanthropies to learn together, co-create, and iterate the guarantees. As you heard from Joel, the federal guarantees have specific boxes. The community investment guarantee pool has what I call a loose box, but it's flexible. And we're working with the intermediaries to find that right guarantee use for the intermediary as well as for the investor. You turn to the next slide. This is a graphic to show you how the pool will work. On the left-hand side, you have the 12 guarantors who have made this commitment in guarantees. It's a 15-year facility, and they've made that commitment to the pool. CIGP then places enterprise or fund level guarantees to intermediaries. So a guarantee would go from CIGP to CDFI. There are 3 sectors: small business, affordable housing, as well as climate. And the guarantee is at the enterprise level. So you are looking at placing a guarantee that would cover a program of lending or a pool of lending. The CIGP does not underwrite each transaction that the intermediary places. Instead, the intermediary has defined their credit box and their program box. So loans that meet that program can get the guarantee. We anticipate that there will be some losses. It is not a program, a guarantee program that anticipates a 0% loss. The investors recognize to have deeper impact into the communities and the sectors they care about, that there is a probability of some losses. We are looking for a leverage of 5-to-1, and impact, racial, and gender equity are key values in the evaluation of the guarantee. So I would encourage you all to think about a CIGP guarantee if you are looking to bring more traditional risk-averse capital into your organization that may need to be de-risked through a guarantee. Or if you are trying to develop a new or expand a lending program that would have deeper impact into the community, but you need to broaden or expand that credit box a bit, and a guarantee from the pool could help de-risk that. Generally, we have the intermediaries take a small first loss position in the guarantee, and then the CIGP guarantee will kick in for some level. So that's the kind of the big picture of what the pool is looking for. We have launched in December, and we have approved a California-based guarantee that should be going to closing later this summer to expand housing, affordable housing lending for historically homeless or recently homed individuals. So we're very excited that the guarantee will be out there to broaden the lending in that sector. What I would like to do now is ask our panelists a few questions. So I wanted to ask both Joel and Christine to give a bit of color to some lessons that they have learned from using and deploying guarantees. So the lessons they've learned or best practices that they have experienced with originating, structuring, and deploying guarantees. So I'll start with you, Joel.
Sure. I will revisit one of the cautionary items I put forth, which is making sure that you create a robust policy around how to adequately service the guarantee and what is expected of you, no matter who's staffing, because depending on how long-term a loan you might be putting on, you might be expected to be, providing updates to a guarantor for the next 5-10 years or longer, depending on what you do. So having a source document that you can go back to, that someone also needs to check in on, because guarantee requirements can also evolve. Programs can change the method in which they need things reported to them, and keeping up to speed. So if you get into a guarantee program, it can be a long-term commitment that you need to be able to service. And with that, I wouldn't try to spread yourself too thin. There's all sorts of great guarantee programs, and multiple ones might work with a given opportunity. But if you could sort of, get good at one, it might be better than trying to have, one guarantee across 6 different programs, right? That can be very taxing on an organization as well. So, whether it's you want to be an ag lender and you get really good at the FSA guarantees, or the BIA insurance program, because it's really flexible, can fit a lot of the needs in your environment. Kind of, get really good at one before you try to spread yourself too thin.
Great, thank you, Joel. Christine, some of your lessons learned?
I think to Joel's point, but in a different context, that long-term commitment piece is important. Terry mentioned the CIGP is 15 years, and we are a funder on that. That's a long, when you think about 15 years from now, that's a while, and there's going to be a lot of market changes and a lot of changes, just generally speaking. So holding that long-term view and really being in deep partnership with the foundation, kind of shifting to thinking of in the philanthropic lens, like having a really deep partnership with the foundation you're working with the intermediary you're working with, having a trusted, I think, track record between the 2 of you or the 3 of you, or wherever you're working, is going to be really important. I think one of the lessons learned from COVID has really been the ability to pivot when we have bilateral relationships set up. And we were able to move much more quickly in a bilateral context than we are moving in a pooled context. And I think the other thing is that it's still evolving around lessons learned, is really getting the use case right and getting what you need for the credit enhancement right. So is it 10%? Is it 25%? Is it, is it your max loan amount of $500,000 or $1 million? Like when you're in the government and you're looking at the federal credit programs, all of that is determined for you. When you're in philanthropy, we're coming up with that from a rational and reasonable place, right? But that is stuff that you can co-create, but we need to get that as right as possible and be open to iterating on And Terry, I did want to just flag for you that there are 2 questions in the chat, because I know we have 10 minutes left.
Great, thank you. And I'll address those questions. The lessons learned for the CIGP, it's a little bit too early to tell since we are now just deploying our first set of guarantees. But what we're finding early on is, as Christine mentioned, is structuring the right use case and really understanding what the intermediary, what risk they are trying to solve for with a guarantee. And we're also trying to identify what is that right pricing. Currently, the CIGP is pricing the guarantee somewhere between 1% and 2% on the amount of the outstanding, the amount of the full guarantee commitment. And the minimum size is $1 million guarantee, and they can go up to $5 million. What we are seeing at this early stage is for smaller intermediaries, that $1 million threshold may be too high. So that's one of the lessons that we're monitoring and seeing, what is that right size. So I think I've addressed the 2 questions in the chat so far. Turning to Joel, can you just briefly talk about what you think the future and growth of guarantees in community development lending finance will be?
It's a pretty broad spectrum. Obviously, you know, all the different current guarantee programs have their own futures and stories of how well they'll be utilized. My hope is, if I zero in on Indian country for a second, you know, perpetually we communally are trying to recruit more banks to be active in lending to Indian country, right? And that's our mission, is to bring banking in. We're not going to be the only bank out there. We want other native owned banks, other non-native owned banks, right? The border town bank, to be able to meet all of the credit needs and project finance needs. And I think the guarantees in general are the way in which you can help induce them, right? Across the banking spectrum and other lenders to say, okay, if you're going to go out of your comfort zone to go into a new market, if Indian country is a new market, do it with a backstop, right? Teach them how to use a BI guarantee and help them, you know, get their board of directors on board to be able to do that. So that's my hope, and I've been seeing anecdotal evidence of more lenders being able and willing to serve Indian country, knowing that it might take more homework, right, to understand what makes that unique. And there's all sorts of books and presentations and doctorates we could do on that subject. But you know, that's my hope, and that the fight will be on the federal side. These programs need to continue to be funded, right? Especially the smaller programs are always under pressure to be, why do we have this niche program out here? Why can't we just all mold it into the SBA program, which doesn't have the specifics in mind for how to support Indian country all the time? So it's a continual battle to make sure there's a sufficient allocation, right? And that the more you utilize these guarantee programs, when I say the communal, you or all of us, the more demand that we have on, like, say, the BI guarantee, I hope they run out of money in January, because they can go back to the Hill and say, give us twice the amount of money and serve that much more, because there's that kind of demand. So that's kind of high level comments on where I hope to see it go. Great.
Thank you, Joel. Turning to the philanthropic guarantee side, Christine, what do you think is the future of guarantees for philanthropy?
I think one of our overall objectives, actually directly parallels with what Joel was saying, was that we want more mission-aligned philanthropic dollars in community, in tribal communities, in our color communities, in low-income communities, in rural communities. Like, the more money that philanthropic and mission-aligned for philanthropy is willing to do, the better, the better. And I say mission aligned and in partnership, because it's not money flowing just for the sake of money, right? It's the right money for the right projects to the right communities. And I think guarantees are a way for that to happen. I see, hopefully in that, scale and collaboration. I think as we continue to iterate on the use case, I would love to see some like actual products, that we have different guarantee products the way we have different PRI products. I think philanthropy has done a fairly good job on the supply of debt to low-income communities when we think about our PRI capital, and we're not anywhere near that when we think about the guarantees. The other thing that I would love to see is how can philanthropy show the private sector that the majority of what they're seeing is perceived risk. It's not real risk. And so how can we also have, Terry mentioned the evaluation of the CIGP, and that was one of TCE's, especially with the guarantors as a whole, key aspects of setting up this new piece of community development infrastructure was that we have to understand both our theory of change and what the outcomes data are going to be, because in addition to the community development and the philanthropic space, understanding that there is a demonstration effect that can show the private sector, especially as we think right now and everything that's going on with the private sector, that this is actually perceived risk. So I'll stop there. Thanks, Terry.
Thanks, Christine. I will also comment that I think for the future, the guarantee pool is a demonstration project of right now 12 philanthropies working together to deploy guarantees and share losses. I think there's a potential to have regional pools to take this model so that you end up with more regionalized guarantee pools that care about a certain geographic area. Could be in the future. Joel, we've had a couple questions that I wanted to ask you to address. Is there a federal loan guarantee program Indian countries should prioritize for federal funding?
I would say if you're spending time lobbying to get better guarantee products, taking the existing programs that are geared towards Indian country would be your best bet. So the OIED, or what I call the BI loan guarantee program, would probably be the place where I'd start. The HUD Title VI on the Housing Authority side would be the next one that deserves a lot more funding. It's just as far as sheer amount of funding, there's a lot more lobbying to be done of other guarantee programs specific to making their regulations play better in Indian country, right? So that they're not just lost in it, better fit in a box. And, we've had situations where guarantee agencies, they want a certificate of good standing from the state. And they don't recognize that you could be chartered under a tribe and deals fall apart, right? Like stuff like that is just aggravating because it's not built for Indian country. That there's lots more lobbying that if those were fixed, we could utilize other programs more. But the BIA guarantee would be the place where I'd most like to have additional allocation.
Great. The next question, Joel, is what's the best way to find out which banks have funding for specifically Native-owned businesses?
I wish I could tell you there was a list of banks that say they do that. There's a couple resources you could utilize. You could start with the Native-owned banks. There are 19 banks in this country that are tribally owned or owned by individual enrolled natives that, by and large, at least service their tribe or know enough to be able to service reservation lending, including Native American Bank. Beyond that, depending on where you are, you're going to have to look around your geography. The community bank, the regional bank that serves your state or area, you're going to have to call around to. Unfortunately, there's not like a list of who does Indian country lending, although you can ask for a list from the BIA Guarantee program of who has signed up. And that is somewhat of a proxy for those that might be entertaining deals. By and large, having seen the list, a lot of them are sort of, they signed up 10 years ago and have gone dormant, or they just service their backyard. But it is a resource you can go to if you're looking to find someone.
Great. Thank you, Joel. We're just about at our time. I wanted to just reiterate that if any of the CDFIs on the call are interested in learning more or talking about a guarantee use with the pool, please reach out to myself or my colleague, Fran Lutz, who is working with the pool, and we'll be glad to talk through any of the ideas that you may have. We also have resources at the end of the deck that talk about the philanthropic guarantees, as well as a resource from last year's convening by Lisa Wagner that identifies links to all the federal guarantee programs that Joel had talked about. And there's also 2 videos, one by Kresge and one about the guarantee pool short videos that would give you a great overview. Just wanted to thank the panelists, Christine and Joel, for your thoughts today and sharing your expertise with us. And thank you to Awista for sharing this very important topic to your audience. So thank you very much.
Thank you so.
Thank you.
Thank you. My goodness, that was so helpful and so informative. Really appreciated that. Don't hesitate. I noticed some chat had started, some good questions that started to come up in the chat. I'm sure Terry would be happy to stay on and chat if there were more questions that you didn't get to answer during this time. We are going to take our break. We'll be back at the top of the hour to learn about and have some time to talk through CDFI resiliency and business planning. So we're really excited about that. After we do that, that session will be on our main conference link here. And then we will then transition for those of you who are signed up to do our regional meeting session. We will transfer over to the link that you would have received from Heather last night of the special Zoom meeting invite. So that's how it's going to work. So stay on this BAT channel, everyone, for the next little bit of the afternoon, and we'll enjoy that time together. You'll hear our intermission music, and we'll be back here shortly. Thank you all.